Hey, AP Economics students. Time to go over a topic that can sneak up on you that's very logical, but if you don't have enough experience playing around with this type of question, it can cause unneeded stress and unneeded confusion. And these are questions that have to do with a bank balance sheet. So I just want to make sure you have all the vocab and you just understand how these work. So I'm going to go through this old AP question from 2012 here in just a minute, but I want to explain how a bank balance sheet works in the context of these questions. So what you're always going to get, and the thing that's a little bit frustrating about these is sometimes they can be inconsistent on the information that they give you. But this part is always going to be consistent. The balance sheet will be divided up into two sides, and the left side is going to be the assets, and the right side is going to be the liabilities. Now, the main thing here is that these always have to equal each other. The left side always has to equal the right side. But the part that's inconsistent is the types of assets and liabilities that you're going to see. So they normally just give you a list that goes down, and it all depends on the question how many things will be there, and sometimes it can be confusing what they don't list, or it can be confusing with how they list it. So I'm going to give you the basics here, and then as we go through a question, you'll see. So one of the things they're always going to have on there is going to be what is called the demand deposits. Now, a demand deposit just means of all of your customers at the bank, how much money can be demanded from your bank at any one time. So basically, all of your customers' deposits added up, that's your demand deposit. This is the total of all the customers' money that is in your bank. That's your demand deposits. Now, your demand deposits get divided up into whatever this number is, all sorts of things on the asset side. So here's normally what you're going to see. Normally what you'll get is what is called required reserves. Well, when you hear required reserves, what you should be thinking about is what is the required reserve ratio, and that comes straight from the Fed. So you can see how this sort of overlaps with monetary policy and Fed behavior. So this is directly related to on monetary policy type questions. If the Fed, with their three tools, remember they have the reserve ratio, the discount rate, and open market operations. Well, whatever the reserve ratio is, that is affecting your required reserves. And so here's what they're going to do. They're either going to say, what is the reserve ratio? And you just figure it out by doing a ratio of required reserves over demand deposits. Or they're going to tell you the reserve ratio and ask you how much do they have to keep in required reserves. One of those two things. Now, the other issue that's going to come up is oftentimes something about loosely connected to the discount rate may come up. And then the other thing, and this can be a little bit confusing, open market operations, you realize, or I know you know that those are the buying and selling of bonds. Well, sometimes banks buy those bonds, and they actually have them as one of their assets. So you don't want that to throw you. Anybody can buy a government bond. Other countries do, retirement funds do, individuals do, banks do. So sometimes on their list of assets you might see a bond, and that just means they bought or this bank loaned to the federal government money. So that can be an asset. So that's why these are always connected somehow to the monetary policy issues. So required reserves will be on there. And then the other thing you're always going to see is going to see excess reserves. Okay, and you want to make sure you just understand the difference between these two things. The sum of, and I'll write this down here, the sum of required plus excess reserves is going to equal total reserves. Should have written that a little bit lower. Is going to equal total reserves. So sometimes, just to be annoying, you'll see on an AP test, they won't put required reserves and excess reserves separate. They'll just put reserves on the asset list, and you're like, well, how much of it's required versus excess? They don't tell you because that's embedded in the question. They have to figure out what each one of these are. So reserves are always going to be the total of required and excess. Most of the time, they have them each set up. Now, it's out of excess reserves that loans are made. So it's very important that you understand that. When a bank loans out money, it has to loan it out from the excess reserves. The required reserves, this money is 100% off limits. Okay, it is off limits. They can't do anything in it. It has to be there. It's required that it's there. Okay, out of the excess reserve, loans can be made. So when you see the excess reserve, sometimes it'll say 0. If excess reserves are 0, the bank loaned out all it could. If there's still some there, they could make more loans. And then also they will use, when they talk about money creation, that'll go to how much money was created through the loan process, and we need the money multiplier. So if you also remember, the required reserves gives us our multiplier, 1 over RR. So another thing you may see, speaking of the loans here, you might see this. It'll be, how much money do you have in loans? And that'll tell you if this is 0, this is maxed out, and if not, it won't be. But this will make more sense in a problem. Again, the other thing you might see bonds. Bonds could be listed. Sometimes it'll say government securities, might say that. That could be an asset. Another thing could be the building itself. Maybe this bank owns their building, they're not renting it, so the building could have a price on it. And then sometimes over here they will have owner equity. Sometimes you'll see that. Okay, so maybe it's a liability for him because he owes money on it. So these are the things that'll be on there. And so the biggies, though, the real biggies are always going to be these two. Required reserves and excess reserves. And you say, oh, that's the reserve ratio from the Fed. I have to make sure whatever this is, I have that fraction in here. And then for excess reserves, that's where I get to make my loans. That'll be informed how many more loans I can make right here. And it's possible these things come up. All right, and these are always getting tweaked here depending on the situation. So we're going to look at a question and see what we can do here. We'll leave this over here for now, and we'll attack this down here. Okay, so here's what this question says. The following is a simplified balance sheet for Mi-Tierra Bank in the United States. So let's go ahead and see what they have here. I have a larger version here. So once again, it's divided up into assets and liabilities. Their required reserves are $10,000. The demand deposits are $100,000. So this tells me that this bank has $100,000 worth of customers. Okay. You have no idea how many, not important, but there's $100,000 worth of deposits. So the fact that they have $10,000 in required reserves, you guys can already do this in your head. You can figure out what the reserve ratio is. It's 10,000 over 100,000. It's a tenth or 10%. Now, the excess reserves, $5,000, they still have some money they could make some loans with. So, for whatever reason, this bank owner or manager has decided not to. Maybe he's just in between making a loan, hard to say. But he has $85,000 out in loans. Now, as I said, these two sides always have to equal each other. And so, 10,000 plus 5 plus 85 is 100,000. And that's the demand deposits, and there's no equity here. All right. So, hopefully you have a feel for it. This is a fairly simple one. Okay. And now let's see what they want to know. What is the reserve requirement? Well, the reserve requirement is always going to equal the demand deposits divided by the required reserves. Okay? Bring that over a little bit. This is always going to be, it's usually one of the easiest parts of the question. So you just look at this and say, oh, well, the demand deposits, according to the balance sheet, is 100,000. Required reserve is 10,000. Simple. It is 1/10, which is 0.1, which is 10%. That question's almost always, the only time this question's difficult is if they don't break down required and excess and they just call it reserves. So for example, this question could have said reserves is 15,000. And you're like, well, how much of it's required versus excess? They don't tell you. But on this one they did, so it's very easy. Let's move on to part B. Part B says, assume Lewis withdraws $5,000 in cash from his checking account at Mi-Tierra. So let's make this one a little more realistic. Let's pretend Lewis is moving, and he decides to go to his bank, close his account, and takes his $5,000 that he had in there with him. Okay? So question number 1 says, how much will the bank's reserves change based on Lewis's withdrawal? Now remember, when it says how much will the reserves, they're just saying, how much will the total reserves? And sometimes they use the word total, sometimes they don't. But just in general, how much will the reserves change? Well, the reserves are going to change by $5,000 because that's what he's taking with him. And this actually might give you a little hint as to why there's a required reserve amount, because you got to make sure you have money available for these situations. So how much are the reserves going to reduce by? Well, $5,000. Okay. $5,000 decrease. Question 2. What is the initial effect of the withdrawal on the M1 measure of the money supply? That seems like a weird question out of the blue here. So if you just remember, at this level of econ, we talk oftentimes about M1, M2, and maybe M3, and you just want to remember this. M1 is how much cash is out there, already created. And remember, we do not have the amount of cash, we don't have currency for all the money that exists in our economy. It's only on paper. And by on paper, I mean, and there's just an account of it, but we don't actually have it. And it's very easy, I think, for you guys to understand that, because think about how often, especially with the dealing with coronavirus, how often are you using cash? Not very. So we don't actually have a need for that actually to be printed. So the M1 is the cash supply. It seems like a weird question, but I'm going to tell you why they're asking it. Remember, when we loan out money in the creation of money, and if we go back to the little theater where we had the 3 gals, and I was the blacksmith, and I was creating money by loaning out their money. When money gets created, money that gets created is going to be either M2 or M3. And so the way they asked this was weird, but they could have said, did M1 change by the creation of money through loans? That would also be no, but M2 and M3 could have changed. And so it's a little bit of an oddball question. Just remember that that's dealing with cash. You're like, this had nothing to do with that. No connection. So the cash amount there was no change. So what's the initial effect of withdrawal on the money supply? No change, because he withdrew money that had already existed. No change. His $5,000 already existed. This wasn't new created money. Okay? So just for example, let's pretend he opened his account a few years ago for opened a $1,000 account, and over the years he's been putting money into the account, and every time he has a paycheck, he goes and puts some in there, and he got it up to $5,000. Now he took it out. Well, the $5,000 has always existed, so this wasn't new money. Okay, now number 3. As a result of the withdrawal, what is the new value of excess reserves on the balance sheet of Mitra Bank based on the reserve requirement? All right, now I'm going to show you this, and make sure you follow along closely, because these are the kind of questions that are the most difficult, because there's a domino effect that winds up happening on this. So let me show you what happens here, because this is not intuitive at all. So what I'm going to do is I'm going to redraw this, and I'm going to insert here all of these numbers that wind up changing. Okay, so here's the assets and the liabilities. So I'm just going to put RR, and this was 10 grand. Okay, and so his demand deposits of the bank were 100,000. Okay, and then I'm going to put ER for excess reserves. Was 5,000. Owner's equity is 0. That's not going to be a factor. And now loans at 85,000. All right. So I'm going to go through the sequence of events here. I'm not going to make the dollar sign. It'll just get cluttered up here. So let's go through the events that happen, okay? So I want to show you how there's a domino effect that winds up happening. Lewis shows up to the bank, all right? And he says, I'd like to withdraw my $5,000. Okay? And the bank says, no problem, because we happen to have in excess reserves 5,000. That was convenient. Now let's pretend that he didn't. He could have taken the $5,000 temporarily from required, and they could have replenished that. But as it just so happens, the $5,000 goes from is in the excess reserve, so that's handy. But before we go to there, I want to show you what winds up happening. He shows up to the bank and says, "I'm withdrawing my $5,000." Okay. Well, then right away, when they give him his $5,000, the demand deposits for this bank have dropped now to $95,000. They've lost a customer. So since this is now $95,000, our required reserves are no longer $10,000. Our required reserves have dropped to $9,500. Okay? Well, that $9,500 means we had $500 extra left in here. Well, what you do with your extra money out of required reserves is you put them into excess reserves. And the $5,000 was taken from right here, so that goes down to 0. So I'm going to go through that from the top. Here's what it looked like at first. Okay, and now Luis shows up and says, "I'm moving, I'd like my $5,000. And they say, "No problem. $5,000 gone. Their excess reserve is 0. And the domino effect is the $5,000 is gone. Demand deposits have dropped to 95, which means now my required reserves drops to 9,500, which freed up $500 that we put back into excess reserves. So excess reserves went from 5,000 to 0 back to 500. And this is what's in here now. $500, 9,500 for required reserves, and demand deposits are 95,000. And if you add all of these up, we're going to equal it. 9,500 plus 500 is 10,000, plus 85,000, 95,000. So the question says, as a result of the withdrawal, what is the new value of the excess reserves on the balance sheet? Well, the excess reserves are now $500. Now, the most common wrong answer, and it's a good wrong answer, but the most common wrong answer is 0. Because people go, "Oh, he just took his $5,000 and we're all good." But what they don't do is they don't take into account that this dropped, which freed up 500 to get put in there. Okay. So B part 3 is a really important question. All right, then part C. I'll put that right here. So in part C, it says, assume the next day John, another customer, withdraws his money from the bank that exceeds the reserves. Let's say it's another guy coming in to move, and John comes in and says, "Yeah, I'm moving. I want to withdraw my money. I want to take out $5,000. And they say, "We can't. We only got 500 here. We got to have our required reserves. We need money. We don't have it." Well, if the bank is in a jam and it needs money, even if it for a split second takes it out of here, it has to replenish that. So don't even think that way. Just go, "Oh, we can only give them 500. They need to come up with $4,500 with my example. But the problem just says it exceeds this amount. Well, they have two choices. They can borrow money from the Fed. And the rate they're going to get charged is the discount rate. By the way, you don't have to state that. I'm just writing it here. Borrow from the Fed, or they could borrow from another bank. And in one of the most annoying vocab issues, the rate they pay from the other bank is called the federal funds rate, which you would swear that would have to be the rate that the Fed charges, but it's not. Okay, but those are their two choices. Okay, so this is a bank balance sheet question, and you want to just be comfortable with the way it works. And so this was number 2 from 2012. And as a side note, question number 3, 2012, actually had a question named after me. The fictitious economy was Anderson Land, so that was fun. So there's this, and I'm going to do one more. So I'm going to erase this, and I'm going to do another bank statement question, and so I'm going to get rid of this and do that one next. All right, this next question is number 3 from way back in 2011, and another bank balance sheet. So using what we just learned here, let's go ahead and look at a larger one right here. And we know before we start that the asset column better equal the liabilities column. And let's see how they broke down the reserves. So they give us two types of reserves, so that's nice. And the demand deposits being $10,000, and the owner's equity also being $10,000. So these two things should add up. So we have 2 plus 8 is 10, 7 and 3 is 10. So we have 20,000 here, and we have 20,000 here. Okay. Now don't let the owner's equity throw you. That's money he would owe, but that's not a part of demand deposits. Just focus on that part. But the list still has to add up. So if we could, even before we even check the questions out, you should be able to notice right away your required reserves. The reserve ratio is going to be 2,000 over 10, or 2/10 or a fifth, or 0.2, 20%. We already got that figured out. We've got customer loans of 8,000. Excess reserves are 0, which means this bank has loaned out all the money it can, which is interesting. It also has $8,000 in customer loans, and then it has another $7,000 of bonds. Now, if they own bonds, that means that they loaned money out to the government. Remember, because a bond is a loan. So that's kind of interesting. And then the building fixtures, $3,000. So you could think the desks, or part of the, maybe it's got a mortgage on the building. That's why there's a liability over here of $10,000. So maybe these are silly numbers, but just for the sake of argument, let's say the whole building is worth $13,000. He's paid off 3. He still owes 10. Think of it that way. But we have $7,000 in government bonds. Unusual, but it's just a type of loan. So if you wanted, you could say, well, customer loans are 8,000. Government loans are 7,000. All right. So let's see what we got here. So part A, we'll go ahead and do this over here. Okay. So question A says, based on their balance sheet, what's the required reserve ratio? Well, we actually already did that. We said, oh, well, required reserves divided by demand deposits. That's always going to give us that. So we have $2,000 over $10,000, which reduces down to 1/5, which is 0.2, which is equal to 20%. Okay. B, suppose the Federal Reserve purchases $5,000 worth of bonds from Sewell Bank. That's interesting. So why would the Reserve be buying bonds? Oh, they need to increase the money supply. That's why they're doing it, for whatever reason. So remember, when the Fed buys bonds, they can buy them from all sorts of. They can buy ones that are already purchased. So the Fed is looking to buy bonds, $5,000 from Sewell Bank. What will the change in the dollar value of each thing be? Well, let's see. Let's go over here. So if the government comes in and says, hey, we're going to buy $5,000 worth of your bonds, you just got an infusion of cash of $5,000, and this just went down. This is now $2,000. Because it says they bought $5,000, it just freed up $5,000. Well, that $5,000 that got freed up now can go right back here to your excess reserves. So notice how this column, the total didn't, this 2,000 is still here. I should have room to write it. So this total here is still 20,000. It's just now 5,000 got put in excess reserves from a sale. So now more loans could be made if we wanted. So the question says for B1, what happened to our change in excess reserves? Well, we just got a $5,000 increase because that is where we put. It's like having a loan gets paid off. Well, that just goes back into your excess reserves. Okay, and then question number 2 for part B says, what will change demand deposits? Well, you guys could see we never even went over here. It's not like the Fed is a customer or anything. They just had stuff we had that they wanted. No big deal. They could have come in and bought, some desks or some plants or something, but they bought bonds we had. So it made no impact at all. So there was no effect. So change in demand deposits, no change. Okay. Part C. Calculate the maximum amount that the money supply could change as a result of this $5,000 purchase of bonds by the Federal Reserve. All right, well, we're going to have to drift into our money multiplier. So if you remember, the money multiplier, not the spending multiplier, the money multiplier is 1 over the reserve ratio. The reserve ratio is 0.2, so our money multiplier is 5. We need that, and it says, so the Fed buys bonds, and we just threw that in there. Well, the maximum effect of that going through the entire banking system is going to be 5 times 5,000, which is going to equal 25,000. So that's actually not a bad example of how when the Fed buys bonds, they're increasing the money supply, because when they buy bonds owned by banks, that immediately goes into money to be loaned, and it really can increase the money supply very quickly. All right, let's jump up here for D. D says, when the Federal Reserve purchases bonds, what will happen to the price of bonds in the open market? All right, this is very important. Very, very important. So, it's one of those things you just want to memorize. If you understand it, that's great. If you don't quite see this, it's one of those things you want to memorize, and it will click later. But when it comes to bond prices versus interest rate, bond prices and interest rates always move in opposite directions. Okay? Super important that you get that. Now, the reason they move in opposite directions is that if interest rates go up, that's going to mean that the value of that bond, or the price of that bond, is going to go down because the interest rates are high, and it means you can usually get a better deal somewhere else. If interest rates are low, the value of that price goes up because you can't do as well somewhere else. So I'm going to show that example with this one right here. So when the Federal Reserve purchases bonds, what happens to the price of bonds? Well, here's what they're wanting you guys to notice. If the Fed is buying bonds, you don't have to draw this, but this is just explaining it. If the Fed is buying bonds, what is happening to interest rates? So this is our money market. So here's our quantity of money, and here is our nominal interest rates. Well, if the Fed is buying bonds, they are increasing the money supply. In fact, we saw that right here. So if the Fed is increasing the money supply, they are lowering interest rates. So our interest rates are dropping because they're buying bonds. So go interest rate 1, interest rate 2. So the increasing of the money supply is getting increasing the money supply is dropping interest rates. Well, if interest rates are going down, and bond prices and interest rates always move in opposite direction, interest rates going down means bond prices are going up. Okay? So it says when the Federal Reserve purchases bonds, what will happen to the prices of bonds in the open market? We'll put this right here. Bond prices will increase. Because interest rates are decreasing. And that's all you have to state. Okay? So the reason, again, bond prices are going up is that when we have an agreement at an existing interest rate, if you have some sort of agreement there that, let's say you have a bond at 5%, and all of a sudden interest rates go down to 2%, well, that bond agreement is really valuable. It's getting a higher return, and the opposite is true. So what this is testing you is that, did you realize that this increasing in the money supply was dropping interest rates, combined with, do you know about this relationship? So you say, oh, bond prices increase because the interest rates are decreasing. That's it. All right, and then E. E is a little bit of an odd question. Suppose that instead of purchase of bonds by the Fed, an individual deposits $5,000 into the bank. So a new customer comes in, deposits $5,000. What is the immediate effect of the cash deposit on the M1 measure of the money supply? So you come in with cash, deposit $5,000. What happens to M1? Nothing. Because your M1 is cash. There's no change. It's a weird question. So they're just testing your vocab. And so they kind of had that thing in that 20 2012. Now, the thing I want you guys to notice is that these two questions are 9 and 8 years old, respectively, and we had to go back this far to find them. But on the AP review test to prep you for the AP exam, they had bank balance sheets. So I'm very suspicious that you're going to see a bank balance sheet on the AP exam. So you want to make sure that you understand this. They're not difficult. It's just a matter of seeing a few of them. You're like, oh, okay, I get it. So make sure you thoroughly go over number 2 and number 3. And there was, I believe, one more. I can't recall the year on the old APs as you're getting ready. All right. So this is a bank balance sheet. And from 2011, number 3, and 2012, number 2, if you want to get your own copy there from AP Central. All right. So good luck as you continue to prepare. Thanks for watching. We'll see you guys next time.